Hello and welcome to The Upside. I'm your host, Emily Enenuevo. From active, factor-based, fixed income to digital assets, Fidelity Canada offers a mix of ETFs for all types of investors, taking into consideration your style and investment time horizon. But why consider investing in ETFs? And what are the significant differences between ETFs and mutual funds? Here with more on Fidelity's ETF lineup and how our new all-in-one ETFs could help you along your investment journey is ETF strategist Vince Kraljevic. Vince, welcome. So nice to see you.
Thank you for having me.
Great to have you here. We're going to dive deep into ETFs and obviously our ETF lineup. And Vince, it's safe to say that everybody is on a different point in their investment journey. But ETFs could potentially help you in your investment portfolio. If you don't mind taking it a step back and explaining maybe to the new investors watching, what exactly are ETFs and how are they different than mutual funds?
Great question, and I think it's a great place to jump off at. And why don't we focus on the similarities first?
Yeah. Let's do that, yes.
Right? Because everyone's like, what's the difference? And if you actually just think about an ETF and a mutual fund, they're investment funds. Both are investment funds, right? And let's just take the example of an S&P 500 passive tracking, right? So that's the most common. Everyone thinks ETFs are passive, but a mutual fund can be passive as well. So you could have a mutual fund that's just tracking the S&P 500 and an ETF tracking the S&P 500. So if Apple's 5% here, it's 5% here. So there's the underlying basket, like what's inside is not really different. And I'm going to complicate it a little bit more. So here at Fidelity, we're launching ETF series on a lot of our successful mutual funds. So if investors are familiar, there's kind of series. So there's like an A series, an F series, a T series. So all those assets get commingled into one fund. So the portfolio manager is just managing one fund. And what we're doing is we're launching an ETF series. So any money that goes into the ETF goes into the same pot of money. So the portfolio manager is actually doing the same work, all the money's together. So really there's not that much difference between an ETF and a mutual fund in what what you're trying to accomplish. It is an investment fund. The difference and the fundamental difference between an ETF and a mutual fund is the delivery mechanism. Right? So one trades through an exchange, that would be the ETF. That's why it's an exchange traded fund. And then a mutual fund is trades through FundServe and trades at 4 o'clock. So it's the differences all arise through the delivery mechanism. So if you want intraday liquidity, that's on the exchange. If you're fine with a 4 o'clock close, like buying and selling at the end of the day, that's a mutual fund. So that's the biggest difference between the two. And I always give the example of Buckley's, right? Or a cough syrup.
If you the bad tasting one.
Yeah. So if you don't like the taste, you'll take the pill. But if you don't like swallowing pills, you'll take the syrup, right? So it's the same underlying, it's just how do you want to take it?
Yeah, it's cool. It's neat how you framed it that way. There's more similarities than differences.
Absolutely.
And just breaking down the different series that Fidelity has to offer.
And as you mentioned, everyone's on a different timeline on what, so whatever it comes, if like you're just trying to get investing and you kind of understand a mutual fund, then trying to learn what a market order, what a limit order is, market on close, all these differences might be overwhelming. It's just take the first step on whatever you're comfortable with. And once you get more comfortable, then you can take other additional steps. And we're always here to try providing education.
And in addition to the new investors that are watching, can you just sort of break down active, passive, factor-based? Like how does that work within ETFs?
Yeah, so active, passive, factor in an ETF or a mutual fund. With regards to those investment styles, you can have a mutual fund that's active or passive. You can have a mutual fund that has factor-based, liquid alts. That's just the wrapper. So the mutual fund and ETF are the wrapper. So the active, passive, factor, that's investment style. So if you think about passive in the true sense of passive, so what I'm referring to is market cap weighted indices, right? So you'll have an ETF that is tracking the S&P 500. You'll have an ETF that's tracking the TSX, the Russell 1000. So those passive ETFs are just buying whatever the index is doing. And again, I have nothing against investing in an index, just as long as you know what you're buying. And it's a good first step. So they're cheap, they get you investing early, that's very good. But you have to be mindful of what you're actually buying. So when you're buying a index, what you're buying, like when you actually think about it for a little bit, it's a trend following investment strategy. So whatever's doing well continues to do well. It's kind of like a meritocracy, right? So Apple invented the iPhone, so it started going up. Microsoft, the operating system. So they deserve to be larger, but the issue is there's these paradigm shifts that happen, right? So I give the example of Nortel. So Nortel went from 0%, then it became 1/3 of the TSX, and then it went back down to 0. So when you're in a passive investment strategy, it's trend following. You are just following that, and there's no risk management, right? So it's fine if you know what you're doing. And the current situation that we're kind of looking at and what we're talking about is there's a lot of concentration with the Magnificent Seven. So now these 7 companies make up 1/3 of the S&P 500. 10 of them make up 40% approximately. So there's a lot of concentration. So there's what happens if they go down, right? What happens to your portfolio? So active managers kind of try mitigating those risks. So they'll try to underweight, they'll try to be in different sectors, but the cost of active is a bit more expensive. So, passive's usually about 0.10, 0.10%, whereas active's like closer to 0.8%. So it's a bit more expensive for that hands-on, trying to make sure that you're investing in the right thing. So there is that trade-off, but there is the potential of, downside protection if anything goes wrong. And then the kind of hybrid in there is what you refer to as factor. So factors are anomalies that happen in the market that if you can take advantage of this anomaly that happens, you can generate outperformance. So a lot of the active managers do have a style bias, and they are kind of trying to go after a factor. So each Warren Buffett, value-based investor, so everyone has this style that they're looking for. And we at Fidelity have been studying these anomalies for half a century, right? So since 1965, I think we hired our first quant. And I always give the example so that people can relate to how we're looking for these. Are you familiar with the TV show, The X Factor?
Yeah.
Okay, not Fear Factor, because a lot of people, because everyone's like, what does worms have anything to do with investing? But X Factor was this show, you'd have a 1,000 contestants show up.
Different talents,
but they all want to be famous, right? You notice that they were all different talents, right? So they all want to be famous. But if you apply that to stocks, you have 1,000 stocks, they all want to be the best stock, right? But there's different ways of doing it. You can sing, you can dance, you can act, you can be a triple threat. Now you can be a social influencer, right? So there's different examples of trying to be famous. And that's just like factors, right? So some stocks outperform because they're value. Some outperform because they're quality, momentum, low volatility. So the portfolio manager, or the judges in this example, are portfolio managers, and they all have their own style, and they're all picking the singer, the actor, and that's what portfolio managers are doing. And that's what the factor approach. Like, we know what's going to work to be famous or what should help outperform. So that's what factor is, just trying to find out how to generate that outperformance, looking at a few fundamental characteristics of the stocks.
Okay, amazing, wonderful breakdown of it. It's always great to have you on the show. Great breakdown of the fundamentals and basics there. Now, Fidelity, I think, offered its first ETFs back in 2018. Now, I believe we have over 50 ETFs on our product lineup. If you can just go through the diversity that the ETF lineup can bring to one's portfolio, and also the all-in-ones and what that offers, if you can break it down for our investors.
Yeah, absolutely. So when we first launched ETFs, it was our factor-based suite. So it was like, do you want value, do you want quality? And then we launched fixed income. So again, if you do want shorter duration, longer duration, investment grade, core plus. And then what we did, we realized that people just want this single ticket solution, something to make their lives easier. And it's probably like the first step a lot of investors take, a one ticket solution that packages everything for you. And that was our all-in-one suite. So what the all-in-one suite is, it takes a portion of our factors. So we have high quality, value, low volatility, momentum. So for Canada, United States, and international. So we have that equity sleeve. Then we have a fixed income sleeve. So we merge asset class categories. So equities are typically risky. Fixed incomes usually offers a ballast, so kind of like levels out the risk return profile. So you have to be honest with yourself on how much risk can you take in your portfolio. So if you are younger, you're not going to retire in 30, 40 years, you might be a bit higher on the risk spectrum. So you might want more equities. And as you kind of approach your goal, retirement, buying a
different
house.
stage of your life.
Different stage of your life. So you have to figure out what your goal is. Be truthful to yourself to figure out where you are. And we kind of developed 6 portfolios for you. So
Absolutely.
all equity to all fixed income. The higher the risk, the higher the potential return. And then we come down, the lower the risk, the lower the return. But it is one of those things that it's a simple single ticket solution based off of the goal that you're trying to accomplish. And we're using this factor-based approach to generate extra performance. And we do use active managers in some of the sleeves where we feel you need active management.
So what I'm hearing is that most of these funds have a bit of everything. So it has the fixed income, the equity, and a bit of crypto?
Does have a bit of crypto. So in our fixed income sleeve, there's no crypto. And by crypto, it's our Bitcoin ETF, right? And then on the all equity, so it's 97% equity and then a 3% sleeve of Bitcoin. And again, we added that into the portfolio because it is a different asset class. So just like equities and fixed income, when you pair two things that aren't correlated, like that don't move together. So when equities go up, usually fixed income might go down, or when stock markets go down, fixed income might go up. Just like Bitcoin, like it offers a bit of a hedge. So it pushes out that efficiency frontier. So you kind of get higher returns for the same amount of risk, so on and so forth. So it does kind of help the risk-adjusted returns in the portfolio.
And the 2 new all-in-ones that we just released, like you said, an expansion of the already one-ticket solutions that we have in our suite.
Exactly. So the first 2 we made, we came out with the balance and the growth because that's where the most need, like most people are buying in that category. Then we launched the conservative and the all equity. And then it's just a natural evolution. We're always trying to come to market with what we see or what people are telling us they want. And we noticed that they wanted a 20 equity, 80 fixed income, and an all fixed income. So that's
it's from their feedback.
It was from their feedback, yeah. And there's another thing that we're doing. We launched the regionals, and we just launched them in an ETF version, and people want them in a mutual fund wrapper. So we're just listening to the feedback that people give us and trying to give people options so that they can achieve their investment goals.
Absolutely. Now, Vince, lastly, I wanted to get your views, get your perspectives in terms of an investor looking at the current market backdrop. And I was just thinking back on since we launched ETFs, how many different market environments investors have been through, right? Yeah. Obviously, COVID, getting out of COVID, rising inflation, now the tariffs, like it's been so many different market environments. And
it's been a few lifetimes. Yeah.
Right, and ETFs have been there along the way. So as we, slowly get into this new market environment and investors are seeing the headlines, like how can ETFs sort of fit in their portfolio and sort of help them along the way?
Yeah, absolutely. So our all-in-ones do come in an ETF and a mutual fund wrapper. Yeah. So again, it's whatever you're most comfortable with. Right. So the mutual funds are usually the first initial step. If you feel comfortable doing a limit order to buying your first ETF, obviously do that. But you got to be more truthful with yourself with regards to what your asset allocation is for your longer term investment goals are. And if you, hopefully everyone does their homework and they look at how our all-in-ones perform relative to our peers. And it's been extremely volatile and they've held up extremely well. And it comes down to the fact that we've married 2 asset classes or 3 asset classes with equities and fixed income and Bitcoin. And on top of that, we've married investment styles. So you have value, quality, low volatility, momentum. So each one of those, not getting too academic and too nerdy, is they all kind of work at a different business cycle.
You're right.
Right?
Yeah.
So value typically works in the early, momentum in the mid cycle, quality in the later cycle, and recession, low volatility. So I think we went through that 3 or 4 times in the last 2 or 3 years. So each one of those helped in the portfolio. So we're always trying to increase the risk-adjusted returns in the portfolio. So we constructed a very robust portfolio to weather most of these kind of issues that arise and will continue to arise in people's investment time.
For sure.
Obviously.
Vince, thank you so much for sitting down with me. Always a treat, always great to get your insights, and thank you for being here.
Thank you so much for having me.
And thank you for watching The Upside. For more investor content, visit Fidelity Canada's LinkedIn and YouTube page. And remember, working with a financial advisor is the best investment you can make on your financial journey. Thank you again for tuning in. I'm Emily AllinOne.